We're back on Morning Trade Live. You're running out of time to get the flowers and make the dinner reservation. Valentine's Day, remember, is tomorrow, but maybe you want to buy your special someone shares of a restaurant instead. If so, here's where notable restaurant stocks are trading this morning. We've got Brinker down 1.4, but the rest are up. We've got Darden up just fractionally. McDonald's holding in there off the back of its pretty good quarter there, particularly when it comes to comps. Chipotle is trading higher, almost 2% in trade right now. So let's go inside out on the restaurant space. Joining us now is Dan Ahrens, who's the Managing Director and Portfolio Manager at Advisor Shares. Dan, happy Friday to you. So obviously we've been looking across the restaurant space this week. We got a pretty good read from Mickey D's posting strong earnings. What have been your takeaways, pardon the pun, from what we've got from some of these restaurants?
Well, the restaurant space overall has been rather tough. Individual stock selection is extremely important. There's a small handful of outperformers that we like a lot. And in our restaurant ETF, EATS, we've been looking at some restaurant-related stocks that might have a little bit better upside at this point than some of the larger, well-known traditional restaurant stocks that we're avoiding, such as McDonald's that you mentioned. We're not in it at all at this point.
Okay, just talk us through who you are looking at, who you like, who you don't like, what you're avoiding, and exactly why.
Certainly. I think it's pretty easy to say that Brinker, ticker symbol EAT, is really a best-in-class performer in the restaurant space. Most people know that Brinker is mostly Chili's, and they've been on an incredible run the last couple of years. You can't watch a sporting event or most major TV without seeing a 3 for $10.99 special advertised. And frankly, your average US consumer sees that as a better deal than most fast food at this point. It gets people in the door to Chili's, and then people spend a larger basket than that $10.99. They can also buy alcoholic beverages there that are a nice profit margin for restaurants, and other items at Chili's. So we really like that an awful lot in our fund. Another top 5 holding is Darden. Darden does a great job of spanning the space from casual dining like Olive Garden on up to fine dining like Capital Grille and a handful of others. So we like that one. But I mentioned a couple of these non-traditional restaurant stocks. We have a top holding in CASY's. Most people know that CASY's is actually a convenience store. But if you've ever been in a CASY's in a lot of small towns in the Midwest, that might be the best pizza in town, a lot of people think. So they do that crossover into the restaurant space in our minds. Another good example of a stock we like is Bros, Dutch Bros. We have that as a top 5 holding, and we're not investing at all in Starbucks at this point, which is huge, of course, not going away or anything. We just don't like the price point and the upside versus downside of Starbucks. We're avoiding it. We see Bros as a much better option.
Okay, and as far as what we're seeing consumers sort of flocking to right now, it certainly seems like value is what's winning here. Where are you seeing the most value, particularly when you look across some of the names that you just mentioned? Because I know, and I say, I take your point about you not being in Mickey D's, but I mean, obviously one of the sticking points in that particular report was how they talked about the headwinds in pricing and then also the value menu, which is raising some concerns around margins and pricing now. But who do you think is well positioned in that kind of environment?
Well, it's in the restaurant space and in our restaurant ETF, it's been a constant movement from one place to another. A couple years ago, it was about pizza and delivery, Wingstop, things like this. Then it moved into the best fast casual names were the place to invest. And now it's difficult, but the top operators, the most efficient operators in casual dining. That means casual, where you might actually have a wait person, but it's not to be confused with fine dining. And here we're talking about Chili's, Brinker, We're talking about Olive Garden, which is Darden. And that seems to be, if we have to focus on one space versus another, that casual dining seems to be the best place. But again, individual stock selection, super important to this point. And fast food is having a tough time right now. And again, it's about inflation, it's about price point and value to the consumer. We do have in our top 10 holdings Yum Brands and Yum China. And they have some unique offerings. The strength from them is not coming from burgers. It's coming from Taco Bell and Pizza Hut and KFC. Some of these rather different types of fast food offerings. But again, it's not our top 5 holdings, but we do have some fast food exposure there.
Okay, glad you left us on the Yum Brands note there, Dan. Really appreciate your time today. Dan Ahrens, who's the Managing Director and Portfolio Manager at Advisor Shares. So let's trade Yum Brands with Tom White, host of Fast Market. What's the approach this morning, Tom?
Yeah, this stock is near all-time highs, just like McDonald's, right? Last earnings, they had 3% national sales growth. That's a positive. Taco Bell was up 7%. They have even had a resurgence in KFC, up 3%. Pizza Hut still dragging on them, but this stock's near all-time highs. It pays about a 1.84% dividend yield. So I wanted to look at a strategy that takes advantage of that if you do want to own the share. So I looked at a covered call strategy. It's neutral to bullish. You collect yield not only on the call that you sell out of the money, but also by owning the stock, you get that dividend yield. So I went for every 100 shares of stock you buy, you sell an out of the money call. I went out to the March 20th monthly cycle. They don't have weekly options. And I sold the 165 strike call out of the money by a few bucks to the upside. You're going to pay roughly about $159.80 debit for that. So you're buying the shares at a discount of about 2% to where it's currently trading. And then you get some upside exposure also. Now, the gains are capped on this, but as you get closer to March expiration, you'll have that ability to roll or adjust that short call, hopefully collecting credits. That reduces your break even, which is the price that you paid. $159.80 is your break even to the downside. And then you get to collect credits, increase potential profitability while still owning the share. So you get paid to wait on this type of strategy.
Okay, a good approach there for Yum Brands, an example trade for us. Appreciate it, Tom. Thanks so much. Trading just fractionally lower there on Yum.